Welcome to Achieve Wealth through value-add real estate investing. This is the show where the guru hype is banned and you get direct insights from commercial real estate operators. If you're a passive investor, this show can help you better understand investment opportunities. And if you're an active investor, the lessons from each episode can help you to become more effective in your own deals. Now, here's your host, investor and author, James Kandasamy.
Hi, everyone. My name is Gunveen Bachher. Thank you so much, Carrie, by the way, for the introduction. Just call me Gavi because Gavi is going to be easier for, I guess, all of us. But I guess most of my clients, they love to call me Gunveen because they find it very unusual. It's an unusual name and they like it. So it's really up to you.
Yeah.
Okay.
And Gunveen, I just want to make sure that I say thanks to you because this is a super hot tax season.
Yeah.
And all tax accountants, CPA are super busy. You know, everybody's working late night, and we really appreciate you joining in at this time, which is important for our investors because a lot of them are getting K1 or going to be getting K1 soon, and you joining at today is really appreciated.
Absolutely. So I'm just going to go ahead and share my screen now and talk about the K1. So can you see my screen? Can you see the presentation?
Yes. Yes.
Okay, you can. Perfect. So, okay, just let me know if you cannot, because just stop me, James or Trevor or Carrie, just any one of you. Okay, so today's presentation is going to be about things that you might not know about the K1 or the Schedule K1 that you might be receiving from your partnership or your S corporation or your syndication. So like Carrie mentioned, this is just a general overview on the Schedule K1 itself. It's information, the information contained in today's presentation is subject to change to the IRS's guidelines. I'm not offering any advice. Please perform your due diligence and Okay, so moving on, what is Schedule K1? Schedule K1 is a form that members of a partnership or an S corporation, they use it to report their share of partnerships, profits, losses, reductions, and credits. Now, partnerships and S corporations are known as pass-through entities in the IRS's terms. Now, what do you mean by pass-through entities? It just means that partnerships and syndications themselves, partnerships and S corporations, themselves do not pay any taxes of their own. So who pays for those taxes? So those profits and losses, they get passed down to the partners, and partners are the ones who are required to report those income and losses and then eventually pay taxes on those income and losses, partnerships income and losses. So whatever the income the partnership earns, it gets distributed to its partners. And then they are required to report their share of income and losses, as well as pay taxes on them. So for the partnership itself, or for the S corporation itself, there is no requirement to pay taxes, though there is a reporting requirement for sure, for which they use Form 1065 to report the partnership's income and taxes. So there's a difference there. Okay. Now, the K1 forms themselves, the Schedule K1, it is different for a partnership versus a K1 for an S corporation, which is different, versus a K1 for an estate or a trust that looks different. And I'm going to show it to you right now. So just let me know if you see this. Do you see the form right now, Carrie, Trevor?
Yes.
Okay. Perfect. Okay. Which means my screen share is going great. Okay. Okay. So this is how your Schedule K1 looks like. And it's a one-page form. And this is what you should be getting from your partnership or your syndication, etc. Now, at the top left-hand side where it says Schedule K1, and if you can see my mouse pointer, it says Form 1065, which means that this K1 is meant for partnerships. On the other hand, the K1 for an S corporation will say Form 1120S, which is the form that S corporations use to file their, report their income and losses. So this is how a K1 for an S corporation will look like versus a K1 for estates and trusts. Now, estates and trusts, they file Form 1041, and therefore this Schedule K1 will say, Schedule K1 for estates and trusts. So that's the only difference. Otherwise, if you see the rest of the form will more or less be the same, for across, all types of entities that we just talked about. Okay. So coming back to my presentation and moving on. So who files Schedule K1? So basically who receives Schedule K1? Now, okay, so let's just say who files Schedule K1. Let's just stick to that. So general partnerships, all limited partnerships, even LLPs, which is limited liability partnerships, LLC with 2 or more members, which by default are partnerships. So the minute a single member LLC, it switches to a 2-member LLC, it becomes a partnership. And S corporations and also estates and trusts, they are the ones who issue K1 to its members, to its shareholders. Now, before I move on, I just wanted to tell you a difference between a general partnership and a limited partnership, because I think it's kind of essential. So general partners are those who are actively involved in the day-to-day decision-making of the business, versus limited partners who have invested their capital, but are not actively involved in the day-to-day decision-making of the business. Now, LLPs are not used very often. I mean, they're not seen very often, let's just put it that way, simply because most professionals can only form LLPs, professionals such as, CPAs or engineering firms, or even architects, or even attorneys as well. So, these are the kind of people who actually form LLPs, and not all states actually allow to even form an LLP as well. So it's not something that all states would allow you to form as well. And there are lots of regulations that go with LLPs as well. Anyways, for today's conversation, I'll be sticking to the Schedule K1, which is more to do with S corporations and partnerships, so just general partnerships. Now, we get to hear this term very often, a K1 distribution. Before I go on into the technicalities of the form itself, the form itself, I want to tell you what a K1 distribution is. So all the profits and losses in a partnership, they are allocated based on the terms and conditions as laid down in the partnership agreement itself, which is created at the start of the partnership or each time a new partner joins a partnership. So in other words, the partnership decides for itself how the income and the losses get distributed to its partners. So there's no one else who decides it but the partnership itself. Okay, and just quick, word of caution that do not confuse the K1 with the Form 1099. Now, a partnership or an S corporation, or I don't know how your syndication is, kind of set up, but if they offer services elsewhere for more than $600 for the year, they will receive Form 1099 for itself. In this case, the partnership becomes a contractor and receives the form. The partners will almost never receive the form, though they will be reporting that income that gets distributed eventually on their K1, but the partners themselves will never, ever receive Form 1099. Well, in most cases, there shouldn't be. Okay. Now, a quick, this is just to remind you that the K1 itself, it reports not just the partnership income and losses, it also reports things such as real estate income, such as in your case, even bond interest, so interest income, royalties and dividends, capital gains, both short-term and long-term capital gains, also foreign transactions as well, and any other payments that you might receive from your partnership in the form of guaranteed payments. And we'll talk about them in a short while. So how to read the K1? Okay, so let me just show you the form, and I'm gonna just quickly move the presentation aside. And okay, perfect. So I'm gonna go ahead and close the other forms. Okay, so moving on. So this is how your Schedule K1 looks like. Now, let's start at the top over here is where you will see the dates. So now we are actually getting into the Schedule K1 itself. The discussion from from here on becomes a little dry. Let me just give you a heads up, because taxes by themselves is a very dry topic, right? So just bear with me for some time and try to make sense of it as much as you can. Okay, so so on Schedule K1 at the top is where you have the dates mentioned for the year that the Schedule K1 is given to you for. Now, let's start with the left-hand side where it says partner's share of income deductions and credits. This is where you enter the partner's employer identification number, the partnership's employer identification number. The partnership will enter it by itself. So the partnership will enter the name, its address, its city, state, and zip code. The IRS center right here where it says IRS center where partnership files the return it depends on which state you live, and IRS has its own center where it will accept your partnership tax return. Now where it says leave the PTP blank, it says here for the publicly traded partnership, that is the area where you're going to be leaving it blank most of the time. Now remember, it's the partnership that's issuing you the K1, so most of these details will be entered by the partnership itself. And I think I forgot to mention about these two boxes at the top where it says final K1 and amended K1. So again, if this is, whether it's being given to you for the final time, maybe you're leaving the partnership or the partnership is being dissolved or whatever. So the partnership will go ahead and check one of these boxes on your Schedule K1. Now, just a quick word on what PTP means in line item number C. So in part 1, it says here, line number D, I'm sorry. So PTP says publicly traded partnerships are basically, they own their own shares and they are brought and sold in the market, in a reputable securities market. So in most cases, this option will remain unchecked for you. Now, so moving on to part 2, where it says partner information, each partner needs to enter its, social security details. So make sure that your information is entered here correctly, your details, your name, address, etc. Also, if you are a general partner or a limited partner in your LLC. Now, in most cases, option under H1, option where it says domestic partner, that's the option that's going to be checked. But it could be that, some of the partners in an S corp or a partnership would be a foreign partner as well. Now, you could think of skipping I1. So what type of entity? Some partners, one amongst you could also be placed as an LLC. So you could be organized as an LLC, and that's exactly what would be entered here as well. So your entity structure as a partner. Now, in item number J, so where it says the beginning and the ending profit, sharing percentages is based on your partnership agreement that I just spoke about. So whatever your partnership is, 60-40 or 50-50 in the partnership, those percentages will be mentioned right here in line item number J. Now, K and L, where it says partner share of liabilities, it can be skipped. So items under K and L can actually be skipped if the partnership is following a cash basis of accounting. But it needs to be filled in if the partnership follows an accrual system of accounting, which means, it maintains its books, etc. And all this information right here needs to be filled in. A quick note on non-recourse and recourse debts, and I'm sure most of you must be aware of what it means. So a recourse debt is a debt that holds the borrower personally liable, which means a lender can go after your property while all other debt is non-recourse. So that information will be filled in here for you by the partnership itself. So moving on to the box where it says, box L. So where it says partners capital accounts analysis, here you tell the IRS how much capital you had in the business at the beginning of the year and at the end of the year. So how much did you actually put in during the year, and whether your share of capital increased or decreased, or did you make any withdrawals or distributions. And, in this case, I would say, where it's a partnership or an S corporation and where there are more than, two people involved, it's generally a good idea to maintain your books, have your books of accounts in place, simply because, we're talking about money here, we're talking about people, relationships, camaraderies and stuff like that. So, I think it's good to have everything on paper, everything very organized, and so that we just pull in that information at the end of the year before the part, when we're entering that information into Schedule K1. So everything is pretty organized. Okay, now a note on item M. Now, item M at the bottom here says, partner contributed any property or not. And check yes if you did contribute any property with a built-in gain or a loss to the partnership. So if you did contribute property to the business, to your partnership, the partnership will say yes, it's going to check yes, or no if you did not. So one of the two options. And what the IRS says is, the IRS defines a built-in gain or a loss as the difference between the fair market value of the property and your adjusted basis in the property at the time you contributed your property to the partnership. So that is what is known as built-in gain or a loss. And that needs to be mentioned right here in line item number M. Okay, so next we move on to part 3 of the form itself. So, and like the name suggests, it says partners' share of income deductions, credits, and other line items here. So say, for example, your partnership makes $200,000 in a year and your share in the partnership is 50%. So which means that you will be receiving $100,000 as income, which you need to report right here. Okay, so this is what it says. Basically, line item number 1 says you need to enter your business income that you made from your partnership. That goes in right here. In line item number 2 and 3, where it says net rental real estate income or loss, this is where you report your share of the rental real estate income and losses. I guess this is the part which is going to be of relevance to most of you. I mean, some partnerships also, besides running their normal business, they also own properties as well, and they lease out all the time. So they receive, income from those properties, and this is where it gets reported right here. Now, in line item 4A, where it says guaranteed payments for services or capital, now these are payments that the partnership makes to you without any regard to the partnership's income or losses that it makes during the year, which means, so if you invested, you can say, okay, hey, guess what? I do not have any capital to contribute, but hey, guess what? I'm an expert at IT services, and I can render my services to the partnership. And then the partnership might say, yes, of course, that sounds great. So if you are great at at IT services, they might just reimburse you for those services, $7,000, $10,000, $15,000, whatever is reasonable pay. And that is what is known as guaranteed payments. That is what gets entered in line item number 4 and 4B. So you basically get reimbursed for the services that you have rendered or for any capital that you have contributed. And you might get reimbursed, on a monthly basis, depending on whatever, the terms and conditions that are set up in the partnership agreement. Okay, line item 5 is to do with interest income from bonds, certificates of deposit, and bank accounts. 6 is all about dividends. So dividend income gets reported right there in 6A, B, and C. 7 is royalties from partnerships. So any royalty income goes in right there. Now in line item number 8, where it says net short-term capital gain or loss. So if you had a property and, if the partnership had a property and they sold it off in less than a year's time, they made any they had a capital gain, they made any income on it, that gets reported right here in line item number, in 8 and 9A. In 9C is all other capital gains and losses, and there's a whole list that the IRS, there's a whole list of, capital gains and losses that the IRS talks about, which is definitely beyond the scope of today's discussion. In Section 10, it talks about any 1231 gain or loss that you've made. Now, 1231 1231 exchanges are basically sales or exchange of any kind of property or any leaseholds or cattle, horses, etc. And all that income that the partnership has made from the sale or exchange of property gets reported right here in Section 10. Now, these properties, these sales or exchanges are limited to a certain type of properties, and not all types of properties qualify for a 1231 exchange. Okay, in box number 11, all other income gets reported. So any income that did not get reported from, in boxes 1 to 10 gets reported right here in box number 11, and such as income from foreign transactions, that gets reported right here in line item number 12. In 11, I'm sorry. Now in line item number 12, where it says section 179 deduction, I'm going to pause here for a while because partnership always has section 179 assets. Each and every, S corporation, be it any kind of, organization, most of the organizations, entities do have section 179 assets. Now, what is section 179 deduction? What the IRS says about is that it allows businesses to deduct the full cost of the asset itself, the full cost of the capital assets itself in the first year of placement. And there are very few assets that actually qualify for the section 179 deduction. Assets such as furniture or equipment, office equipment, maybe even some computer software as well, and even business vehicles to qualify for the section 179. So it simply means that you're not depreciating the value of the asset over a longer period of time, rather depreciating it in the year of its placement. So you get a great deduction in the first year of placement of the asset itself. Now, unfortunately, buildings and land do not qualify for section 179 deduction. Although some equipment attached to those buildings, so say for example, if it's a multifamily home and in which there are some depreciable assets, some assets that do qualify for the section 179 deductions, and those assets are such as your alarm systems, your fire suppression systems, your air conditioning units. These are the items that will qualify for the section 179 deduction. Now, what does not qualify is leased property that does not qualify for such a deduction, and also assets used for personal use within the business that do not qualify for section 179 deduction. I'm sorry, I had to stop at this for a while because this is a very important deduction from just all perspectives as well. And I think I just took some extra time right there. But anyways, now, moving on, box number 14 is important because so the value here has to match the value that is given in line item number 1. Whatever you made in terms of income from your partnership, that's the income on which you pay your self-employment taxes. Now, self-employment taxes are up to 15.3%. They include your Social Security and Medicare taxes. So in most cases, like I said, the value in line item number 1 should match the value in line item number 14. Okay. In 15 is where you claim your credits. Credits such as your low income housing credit or your disabled access credit, your work opportunity credit, even if the partnership is claiming research and development credits and is finally distributing it. So your share of R&D credits, everything gets reported in line item number 15. In 17, in line item 17 is all about alternative minimum taxes. Now, this particular concept or the concept of AMT is applicable for earners, people who are making more than $200,000 in income. And the reason why this concept was introduced by the IRS was because it wanted to make sure that, that the high income earners are paying their tax correctly. And that, and for that purpose, the tax is calculated twice under this system. And and you don't have to worry about it, I'll be honest, because the tax software itself, it calculates for you. So even if you are making more than $200,000, the software itself will calculate whether you are eligible for the AMT or not, whether you will be paying, based on the AMT calculations or not. Okay, so moving on with line item number 19, where it says distributions. Now, the partnership can distribute, not just income and losses. So it will not just reimburse you. You will not just be getting your share of income or losses, but the partnership will also say, hey, we might be, willing to pay you your share of cash or any securities or maybe even property as well. So some partnerships also distribute securities such as, stocks and bonds, etc., or even properties to its partners. And all of that information, it gets reported right here in line item number 19. 21, line item 21 is if the partnership incurred any foreign taxes. That is, and your share of those taxes will get reported right here in line item number 21. I'm sorry, did I say that 21 twice? No, I don't think so. Okay. So I'm going to bring my presentation back again, and I just want you to be mindful of a few things. So that was it for as far as the, the form, the Schedule K1 is concerned. I think I went through most of the line items that might be applicable in your case. So what is Schedule K1? What does it look like? And, what are the various line items? What are the details that you should be mindful of, when you receive a Schedule K1, all the little details such as the EIN number, the social security number, or, the address, these little details just add up, and you have to be very careful that all those details have been entered correctly. Okay. So the next piece of information that might be of use to you is that that you receive your Schedule K1 on time, and that's important, right? So if you are if you are a partner in a partnership, you will be receiving a K1 that says, for a partnership, and we talked about it, right? The K1s differ, right? So make sure that you receive your K1 on time and that you attach your K1 to your 1040. That's in case if you are filing Form 1040, your individual 1040 for yourself. So when is the K1 due? I'm going to be talking about a few deadlines because it's going to be I have to talk about compliance as well, right? This discussion is meaningless if I do not talk about deadlines. So partnerships and S corporations, they have a filing deadline of March 15th, which means that's the time by when you should be receiving your Schedule K1 as well. That is if the partnership follows a calendar year ending, which means it's December 31st was when the partnership or the S corporation closed its books. So, which means that you will have 1 month. So you get 1 month's time to attach your K1 to your individual 1040 and file for the April 15 deadline, assuming that you're not filing for an extension on your 1040, on your individual 1040. Now, in case if the partnership or an S corporation is not does not have a calendar year ending, it has a fiscal year ending. In that case, the Schedule K1 will be given to you no later than the 3rd month after the end of the fiscal year. So I'll give you an example here. If it says, if the partnership it ends on, say, February 15th, then in that case, you should be receiving your K1 by May 15th. So 3 months after the end of the fiscal year. Well, I guess that brings us to the end of the presentation. And those were some of the sources that I used. Well, of course, I used more sources as well to bring all the content together for you. And that's it from me for now. If you have any questions, feel free to ask me. Thank you.
Yeah, now's a good time. If you feel like you'd like to unmute, if there's anything else you want to dig into, now's the time to do it.
That was fantastic. Thank you.
You're welcome. Thank you so much.
Yeah,
Very
I mean,
useful.
just a reminder, I mean, Gunveen also, talks about a lot of other topics like LLCs and, a lot of other things, right? So, I mean, we just carved out this K1 topic today because we have a short time, but so you can ask a general question as well.
So I had a, can we take a sample property and just fill in this form, like a small one? Is it possible?
I'm sorry, what do you mean? I'm sorry, I didn't get the question.
Like a sample property and fill this for one partner? A typical.
So do you mean you're organized as a partnership yourself? Or?
Yeah, like a sample property and how did it get filled? Yeah.
Okay, so if you are organized as, the K1 is issued only if you are organized as a partnership or an S corporation. So if your property or your properties are organized under an S corporation, then, and there are multiple partners in that S corporation besides yourself, so maybe there's someone else as well, and both of you are maybe partners in the firm, then in that case, yes, you can issue a K1. Well, a K1 is good, is mostly applicable in partnerships. It works really well. Some people like to run wages, so run payroll as well for themselves. So if there are maybe two people in a partnership, or they prefer to run a payroll as well on themselves. It mostly happens in the case of S corporations, and having an S corporation and running payroll for yourself is also another great way to save money in taxes too.
Yeah.
So just to answer your question, yes, you can issue K1. That is in case if you are organized as a partnership and your properties are placed under that partnership.
Yeah, I think Gunveen, what he was asking is, can we like on real time fill up this K1 form for one deal? I don't know whether we have time for that or not, but
Just at least the numbers, not
yeah,
the.
you're trying to get her to do a CPA work right now on real life. We just got the time to present how the K1 now.
There's so many details to capture.
Yeah, that's why we hire CPAs. They're professionals, right? So, but anyway, Gunveen, I leave it to you.
We have at least one question in the chat, and I can go to that one. Is this okay?
Yeah, absolutely.
Yeah. Okay.
Bonnie asked, in Form 1065, Section L, is if there is a negative loss in the current year net income, how does that help an individual in terms of tax? Can that loss offset other capital gains in the same year?
Yes, it does. It does. So if there is a loss in the partnership itself, so if there's a loss on the K1, it will definitely help you offset your other income for sure. So yes, that's right. Mm-hmm.
Okay.
There's another question like that. It says he would like to complete a real time.
Oh, that was this referring to the same question, I think.
Okay. Okay. Yeah.
So Gunveen, I have a question which a lot of people ask me, a lot of investors ask me. So we have depreciation every year that we are taking, right, as on a bonus depreciation or cost segregation. And at the end of the property investment, which is like say 5 years, and we have a depreciation recapture, right, with a rate of 25%, right? So where does that go? I mean, where does the recapture go at that point of time? Because unless we're doing a 1031 exchange, I know it goes to 1031 for the next deal, but if you don't use that 1031, what happens?
So that's a good question, and I get it from many people. So people are afraid to take depreciation simply because they say, okay, you know what, we might have to pay it off eventually, in a form of depreciation, recapture tax. But that generally happens only when you are disposing of your asset, your property. And assuming that you are disposing of your property, in maybe after 10 years or something like that, it's okay to pay depreciation recapture taxes of up to 25% then. And I'll tell you why, and just listen to me very carefully here. It's because we are using depreciation now and as an expense to create losses, right? To show as losses on our, on our taxes against our passive income. And whatever money we are saving money now, basically. So it's based on the time value of concepts, right? The time and any money, any dollar that we save now is definitely going to be worth more, right? So it's worth saving more money now than and just postponing paying taxes as much as you can, right? So basically, we are also deferring taxes and deferring paying taxes, and tax deferment by itself is a great tax planning tool. It's a great tax saving strategy as well. So take the deduction now, and obviously at the same time, you will also notice that the property is appreciating in value as well. So not just are you taking those losses, creating those losses, taking depreciation and expense, taking those losses. At the same time, when you are disposing of the property and assuming that you're not going in for a 1031 exchange, then it's okay to pay those recapture taxes simply because you've saved more now, right? You've used that income to offset against, those losses to offset against your income, right? And you're saving tens of thousands of dollars in taxes now, right? So, and, who knows, maybe after 10 years, you go in for an exchange or, something else happens. So it definitely makes more sense to take depreciation, even go for cost segregation as well. I think cost segregation by itself is a great tool. You can actually depreciate the value of some of the assets, such as your HVAC systems, your alarm systems, all of those systems now in the next 5 years. And these are all real assets. So all the real assets in your multifamily home, they can be depreciated over a period of 5 years versus 27 years or 27 and a half years or 39 years, right? Depending on whether it's a residential property or a multifamily home. So I definitely encourage real estate investors, even private landlords as well, to take depreciation and even cost segregation if they can to offset their income. So, yeah.
Gunveen, just to add to that, or a follow-up question, you're actually making money if you are in a higher tax bracket than the depreciation recapture at 25%. Is that true?
So, like I said, depreciation recapture tax is something that does not kick in immediately. It's something that you only pay for when you are disposing of the property. So, and it's up to 25%, depending on what tax bracket that you are in. And so if you take that depreciation as a mandatory expense now, and use it to create, more losses and offset those losses against your passive income, then you definitely, it's a win-win for you because, who knows what's going to happen after 7-10 years, right? I don't know what you're going to do with your asset, right? You might think of going for a 1031 exchange or, so on and so forth. So it definitely, like I said, just to answer your question, I think I did answer your question, right? So just to answer your question, it is up to 25%. So it's not 25%, it's up to 25% when it comes to depreciation recapture tax.
Well, maybe I can rephrase that question a little bit. Let's say, for example, I'm in the 35% or 38% tax bracket, and I invest in a multifamily syndication, and I get the depreciation, that bonus depreciation year one. So I'm going to be deducting off of that 35% tax bracket. And then when the property sells in 5, 6, 7 years or whatever time frame that is, I recapture that depreciation at 25%. So I guess what I'm saying is, do I make 10% or 13% in this case? I mean, am I saving 12 or 10 or 13% on my taxes? Because of that difference in my current tax rate that I'm saving on right now versus, 5 or 6 years in the future?
I think it depends on your, financials as well. It depends on many other factors. So it's hard for me to say how much do you actually end up effectively be paying in terms of, depreciation. It's a very general question. It's hard to actually come down to numbers. 10 to 15%, is that what you'll be paying in terms of depreciation? I don't think so. It could be more as well in some cases too. So it's hard to say, some people are really afraid, that's why, of taking depreciation as well, now, simply because they want to avoid the whole idea of paying, recapture taxes at the time of disposing their assets. But you know what, many people realize is that these assets can actually be cash cows as well over a period of time. So what they do is they put those properties into estates and trusts, and then they just pass it down to their heirs as well. So besides the 1031 exchange, they even just, decide to, do inheritance planning and stuff like that. So like I said, it's hard to say how much percentage is it that you'll be actually effectively be paying. It's definitely something, but again, like I said, you'll be saving so much in the current years that you probably would not mind paying those recapture taxes later on, 5, 7, 10 years down the lane. Because whenever you buy a property, in most likelihood, it's going to be for the long haul, right? Let's assume you're going to be holding on for at least 5 to 7 years, at least 10 years as well, right? So,
yeah, I can try to help to, maybe I can try to simplify Peter's question, because he's trying to see whether somebody is telling him invest in real estate and you get 10% discount. Correct, Peter?
Well, I'm saying if you're in a 35% tax bracket and then you got to pay 25% later,
Yeah.
make it 10%,
don't listen to that guy, because they are not.
Yeah, exactly. No.
Whoever talking about you, about they probably know. But let me explain this. So when you do a normal profit on any real estate, of course you have to pay tax, right? So at the end, when you sell, there's two profit that's coming out at the end, right? So there's one called capital gain, right? That's the whatever profit you get, they're going to split into two. One is called capital gain, and the other one is the depreciation recapture. So the tax gain that you are talking about, 35 versus 20% capital gain, that's a good valid gain, right? Depreciation recapture is basically, it's an incentive. I don't know. I mean, Gunveen can explain that better. It's probably incentive that's given by the IRS. Even though you took 100,000 total depreciation recapture, they're going to only charge you. They're going to only take back 25%. So I don't know. In my mind, they basically have given you 75% discount on whatever you took throughout the year.
So
right,
right, exactly, and it's like I said, it's nothing to be very kind of fearful of when it comes to depreciation recapture. Depreciation is a great incentive tool that's been given by the IRS to investors, which they can take for as long as they hold on to the property. So, and at the end of it, the IRS, what it wants is it just wants a small percentage, basically a slice from the cake, at the time of disposal of the property, which can be anything between 0 to 25% in the form of recapture tax. So nothing to be very fearful of. And I would say, if you watch most of the videos on recapture taxes, eventually you would see that you have had a great return on investment over the years. And
and also when I did my CCIM, we have to calculate all this tax reduction, right? So it's not exactly 10%, but you do get a much better tax rate when you go through this entire mechanism of real estate, getting depreciation, recapture, and capital gain. So it's actually a long calculation you have to do to learn that. The other thing that you don't forget is not only 10% discount. It's like if you hold the property for 5 years, you basically get difference of your whole, your time value of money, right? And I do have a table in my new book which shows that $2 compounded for 25 years becomes 72,000 with tax, and without tax it's like 1.2 million.
Right.
So that's basically a time value of money play there. So definitely gain a lot of things.
Absolutely, absolutely. So yeah, those NPV tables, those net present value tables are actually available online everywhere. So if you just punch in those numbers, and you can see that the value of your property is the value of your dollar, definitely, it's worth more. And so, like I said, everything works out pretty well if you plan out well. So in most likelihood, going in for 1031 exchanges is a great way to also make money, right? And most of you always might have done it already, right? So yeah. And don't listen to people who say, 10% things and stuff like that. Don't listen to those investors or whatever, those syndications, I would say. Don't, just stay away from them,